our headline guest. He manages $2.6 trillion as the CIO of BlackRock's global fixed income. He's also the head of the global allocation team. Rick Rieder is back with us, and how timely it is to have you with us, Rick. I hope you heard Steve's new reporting and the way that we discussed around it. You've made the argument on this program and elsewhere that the Fed's doing too much, that it needs to pull back. Does the timeline and the mechanism and the message and the way that they're going to deliver that feel okay to you?
Yeah, I mean, by the way, I think Steve described it exactly right. I mean, it's going to well into 2022, they're going to be buying assets. This is not like the Fed is tightening policy. I mean, 2018 policy was too tight, and they needed to pull back. They needed to make it a bit easier. This is we're operating at the same conditions we were operating in before vaccine, i.e. the Fed can pull this back. I mean, there are some parts of the market. Fed's buying $40 billion a month of agency mortgages. Agency mortgages trade at negative 40 basis points spread, meaning extraordinarily low real rates. We don't need to keep doing that. And quite frankly, I think Steve described it right. There's nobody in fixed income who doesn't know this is coming. There's nobody, by the way, there's nobody in the markets who doesn't know this is coming. And it's just not that scary. I mean, we go back to other periods in time when the Fed tapered, and maybe it was a bit disruptive in terms of the way they did it. This Fed has seen the playbook, knows the playbook, and it's just not that scary at all. And however, I actually think it's a bigger risk that they don't start tapering, because you think about what's driving, what concerns investors and what concerns corporate CEOs, CFOs today. Overheating, wage pressures accelerating too far, input costs accelerating too much. Listen, we could pull back a little bit with excessive emergency conditions and the markets will be just fine.
So on what the markets are going to do, you were with us last month. You told us you were holding on to, quote, high levels of cash. OK, so Leisman's telling us there's not going to be a taper until December or January. Are you still holding on to high levels of cash? Or are you now feeling more free to put some of that to work?
So, I mean, there's one, when you think about what cash does for you. By the way, I was looking at this, at the last payroll report, the S&P 500 was after the reports, I think 42.32. We're sitting at 42.09 or 42.10 today. So it's not like the market's running away from us. The market's waffling around. Cash is a really interesting asset today because you think about what is mispriced in the market. Treasuries are mispriced. Agency mortgages are mispriced. We've kicked those assets, for the most part, out the door. Why own them? All they're going to do when rates move higher, those are going to hurt us. I'd rather take my risk in equities. And so we're running cash because we've kicked those assets out the door. The other thing that has been a godsend in an environment where it's hard to hedge your risk, treasuries don't hedge your risk, volatility has come down tremendously. We were able to do last week a couple of times buy call options on the S&P 500 at 10 vol. I mean, when you can, it doesn't make sense to hold a lot of outright equity exposure when volatility is that low. You can use convexity, you can use the call option market and create the same sort of upside convexity to your portfolio. Greater upside convexity. So cash just allows you to be opportunistic and allows you to take advantage of opportunities that present themselves. And it doesn't mean you don't have to be in the market. We are in the market. We are long equities. We're just not long the other stuff that does nothing for the portfolio today.
Understood. I mean, that'll be a good quote that comes out of this. I'd rather take my risk in equities. And as I turn back to the gang, along with Leisman, let me also let you know his full write-through is on CNBC.com, which I urge you to go read. It flushes this out even further, gives you a clear understanding as to what the Fed, according to his own reporting, is thinking right now about their message and their methodology about when they're actually going to do this. Steve, forgive me for cutting you off earlier as I wanted to bring Rick in, but let me come back to you.
Yeah, no, better to bring Rick in. I was just going to underscore the concern that both Surratt and Rick have now said. Look, you can't go and run the same pass play again and expect the same exact outcome, even if you execute it better. So the circumstances are different. There's a different risk in the market, and that risk is inflation. And the real risk here, I think, is maybe not the one that we're looking at, which is, does the bond market freak out? Rick is the bond market. He's already told us he's not freaking. So we're good with that. The other issue, though, which is the idea that the Fed has this glacial pace and tries to avoid a taper tantrum at the risk of allowing inflation to fester and to happen in a way that becomes more permanent than it is the Fed's current idea, which is that it's temporary. So that is the risk we want to watch out for. And then the question is, what is the upside on things like the 10-year in those cases that you need to be careful of, where you can get burned in your fixed income portfolio?